it is going to be my distinct pleasure to introduce to you Matt Sorensen. Now, Matt is an incredible guy, and he's been so giving of himself and of his time to be able to come here tonight and to be able to share some really great information with you. Now, like I mentioned before, Matt is the best-selling author of the Self-Directed IRA Handbook. He told me just the other day there's a new edition that came out. This is actually Matt's book right here. The Self-Directed IRA Handbook, a phenomenal resource, probably the single best resource in the industry for how to utilize self-directed IRAs. And he's sold over 20,000 copies, which, as also a published author, I can tell you that is an unbelievable accomplishment. And it's probably the most widely referenced and used book in the self-directed IRA industry. He's also an attorney. He's advised thousands of clients with self-directed retirement plan investments and has established IRA and LLC partnerships. He knows his stuff. He's a phenomenal speaker. He is a true expert. And let me get this out of here. And I'll tell you what, you are really going to enjoy listening to Matt. So without any further ado, I'm going to turn some time over to Matt Sorensen, who can talk to us a little bit about self-directing IRAs. This is a man who is a world-class expert, and I'm so excited to have you. Matt, thank you so much for joining us. It is such a pleasure to have you. Thank you for being here, my friend.
Hey, thanks so much, Kevin. Well, I'm going to try and live up to that today. But thanks for sharing my book and all the details about me. I'm just going to dive right into it, guys. I'm going to share my screen here, which has my presentation. And let's just get after this topic. So one thing I did want to note as we're getting started here is there is this chat window. You know, we'll try and take questions as we go. Maybe Kevin will help monitor that. But what I want to do first is just do some lecture. Sorry, but I want to get as much content out to you in the hour and a half we have together. But what I found over the years, and particularly in these types of formats, is it's most helpful if I can just kind of lecture. I'm going to cover most of the questions people are going to initially ask. I've been doing this for years. And then after that, though, we will I'll come back and we'll have plenty of time for questions at the end. So let me get the presentation going now. All right. Okay, so hopefully you can see that there. You see the presentation. So what we're going to be talking about is how we can use IRAs and retirement plans to purchase real estate. And this is, my topic. It's something I love talking about. I've been working in this area specifically since 2006 as an attorney. And as Kevin mentioned, I've advised thousands of clients. Many of the self-directed IRA custodians in the industry are clients of mine, and I consult them directly. I speak all over the country on this topic, and it's kind of been my passion. And what we're going to do, though, is my goal today is for you to understand the opportunity and the rules on how you actually pull it off. So when we start talking about retirement plans, there's all these quirky rules on what you can and can't do. And I like to tell people self-directing a retirement account is kind of like playing a board game for the first time. When you start out, you need to play with someone that already knows the rules, or you need to read the rule book. And the rule book could be my book, the Self-Directed IRA Handbook. But you need to at least play it with someone you know or read the book. And seriously, because if you don't do that, you'll start playing the game, so to speak, and you'll get around the board a couple times, maybe buy some properties, and you probably screwed something up. You've inevitably done something wrong. And this would happen even if we were just playing a board game. So it's important to learn the rules. Now, that being said, it's not rocket science. It's really, once you've played the board game once or twice, you know how to do it the third and fourth time. You don't need to play with someone else, and you don't have to, read the book every time. So, but you need to do it the first couple times. And that's my goal today, is make sure you're ready to kind of to get started and not make any mistakes, and play the game, so to speak. Now, before I get too far into the content, I've got to give you a disclaimer. I am an attorney, so I'm going to follow my own advice here and just let you know, don't listen to anything I say. This is meant to be educational in nature, and I say that jokingly, but seriously, seek out actual professionals when conducting transactions. And but the goal of this is simply to be an educational event. It doesn't constitute an attorney-client relationship, though. Although we're happy if any of you need help in this area or other areas with legal or tax advice. So I'm a partner at the law firm KQS Lawyers. In our Phoenix office. We have an office in Utah, one in Idaho, one in Southern California. We do a lot of tax and business planning. We set up estate plans. We set up LLCs and corporations for clients. We do IRA LLCs, solo 401ks, pretty much all this stuff in the real estate world we've been doing for years. And it's really our niche and what we're good at. I speak all throughout the country on this topic to RITA, which is the National Association for the Industry. I also have my own self-directed IRA summit, which is a full long day summit. It's August 4th this year in Irvine, California. It's a full day event on self-directed IRAs. Now, my book, as Kevin mentioned, is the Self-Directed IRA Handbook. The second edition literally went up to Amazon just a couple days ago. So the second edition is now available. I sold over 20,000 copies of the first. So you'll definitely want to check out the second edition, which was just literally released days ago. All right. Let's get into this topic. Why are we talking about retirement accounts to a group of real estate professionals and investors? I mean, a lot of times I think people, when they're thinking real estate and they hear retirement accounts, are like, what? Those things don't go together. But there's really 28 reasons why we're talking about this. And it's actually 28 trillion reasons. There's $28 trillion in retirement plans in the United States right now. And that number to me just blows my mind, because this is the most investable section of dollars in the United States, period, in the world. There's no greater number than this that can be invested into real estate. But a lot of people have not even understood that this 28 trillion can be invested into real estate. Real estate professionals haven't understood it. The individual account owners haven't really got it. And there's a lot of people finally picking up on this. Like, the guys at Done For You, I've been working with them for years on real estate transactions with clients who use retirement accounts. And people are like opening their eyes. And this industry's really grown for people using retirement accounts to buy real estate in the last 10 years. And it's something you're going to see continue to grow. I mean, if you just look at the money in retirement plans, 11 trillion in 2000 to 2017, almost $30 trillion. That's huge growth. We're going to see this double again in the next 15 years, or triple. That's almost a triple number there. So what are we going to be at, 100 trillion in the next 15 years? So, and all this money, is stuck in the financial services industry, because most people have their retirement account with a financial service industry, a company, like they have a Fidelity account or a Merrill Lynch account. And if you have an IRA or retirement account at a Fidelity or Merrill Lynch, and you go to them and you say, hey, I want to buy real estate with my IRA, they're going to say to you, you can't do that. And what they're saying is, an IRA at Fidelity can't buy real estate, or an IRA at Merrill Lynch can't buy real estate. You see, IRAs, from when they were created, have always been able to invest in real estate. They can invest in small businesses, startups, private equity deals. They can buy precious metals. All these investments that are normal investments have always been allowed for IRAs. It's just that people didn't know they could buy it because everyone's account was with a financial services industry company. And financial services industry companies sell your IRA financial products. That's their business. It's like if you went into Arby's and you say, hey, I want a chalupa. If you're at Arby's, they're going to say, you can't have a chalupa. But that's not because you can't actually have a chalupa. That's just because they don't sell it. So if you're at Fidelity with your IRA and you say, I want to buy real estate, they're going to say, sorry, you can't buy real estate. And that's just because they don't allow you to have that. So what you need to do is move your retirement account to a custodian who allows you to self-direct. There's over 30 companies now that allow you to self-direct your IRA. And basically when you have your IRA with them, they'll say, great, invest in a startup, invest in an LLC. You want to buy real estate, a single family rental, a duplex, whatever. We'll let your retirement account own that. Your retirement account makes all the profit, receives the rental income. If you sell it and make a gain, it goes all into your retirement account. And so there's lots of options out there. And if you need custodians, email me. I can, can help direct you on getting in a custodian that can, custody your account and move you from like, your Fidelity account or your TD Ameritrade IRA over to a self-directed IRA. Now, there's a lot of things to know and why we're talking about this. And the first thing I want you to think about is how you can invest your own money and assets into what you know. If you're working with Done For You, or if you're a real estate investor and you have a retirement account, a lot of who I come across, my real estate clients, they have a retirement account and they're good at real estate, but they own mutual funds in their retirement account. And to me, that just doesn't make any sense. Like if you're in the real estate industry, or if you invest in real estate and that's what you spend your time learning and working with people in, then why are you buying mutual funds with your retirement account? I mean, you should invest in what you're good at and what you know. So if you are good at real estate and you know real estate, invest your retirement account in real estate. It's like LeBron James, if LeBron James is good at basketball, why would he be playing ping pong? He shouldn't. He should play basketball, okay? So if you're good at real estate, invest in real estate. Now, the other thing I want to talk about is retirement accounts also have tax-free or tax-deferred growth. So if I have, let's say I used an IRA to buy real estate, and let's say I bought it for $100,000 and I sold it for $150,000. Well, you've got a $50,000 gain there. And if that money goes back into your retirement account, you don't pay any taxes on the gain. It builds up in your retirement account, and then you go buy another property. Just like the rental income cash flow, it's not taxable, it builds up in your retirement account. So remember, retirement accounts have special tax treatment. When you're making money on your investments in your retirement account, whether it's a stock or whether it's real estate, you don't pay any taxes, federal or state, on the income and the money that your retirement account is making from your investments. Now, remember, the largest concentration of money for retirement accounts the largest concentration of money to be invested in America is in retirement accounts. This could be your own little sliver of the retirement account industry. And if you're in that boat, this is a really important topic. Now, the last thing I just wanted to say is the Government Accountability Office, the GAO, did a report on self-directed IRAs a couple of years ago. I actually consulted. I was one of the people they consulted with on the report. And what they found was the large IRAs, what they called mega IRAs, over $5 million, majority of those accounts were self-directed IRAs because it was people who were investing what they knew and were doing really well. And the way this report got sparked was from Mitt Romney. Mitt Romney, if you remember from the last presidential cycle, the Wall Street Journal and New York Times did a lot of reporting on it, and they found, wait, Mitt Romney's got a $100 million IRA. How does he have a $100 million IRA? Well, he was investing in startup and turnaround companies that he was consulting with over the years. And they realized we're really good at helping these types of businesses. These companies need money. And, this is like Sealy Mattress before anyone heard of it, or Staples before there was one Staples store. And so they were investing in these companies that they thought were going to be successful. And they decided, we're going to use our retirement accounts. We're going to invest in what we know. And so that's the same principle that I want you to think about for yourself right now is, how do I invest in what I know? All right, so I mentioned this just a second ago. Remember, the IRA gets the same treatment. If you buy real estate and you have a gain in it, that gain goes back into the IRA. You don't pay tax on it. Just like if you buy stock and sell stock for a gain in your retirement account, you don't pay tax on it. That's the perks of a retirement account. Now, the first thing to keep in mind is when you're investing with an IRA, you have to remember everything needs to be in the name of the IRA. If this is Matt Sorensen's IRA buying real estate, Matt Sorensen does not own the property. Matt Sorensen's IRA owns the property. So if my IRA is out buying real estate, I'm going to have a custodian of my IRA. Let's say it's ABC Trust Company, Matt Sorensen IRA. If that's the case, then ABC Trust Company, Matt Sorensen IRA is going to be on the contract to purchase the property. They're going to be on the deed when the property closes. ABC Trust Company, FBO, Matt Sorensen IRA, and FBO just means foreign on behalf of, is going to be the one that receives the rental income. My custodian of that IRA is who I tell to pay the expenses. And maybe I have a property manager in the middle who receives rental income and pays expenses and sends cash flow to my IRA. But the important point here is this is not Matt Sorensen owning the real estate anymore. This is my IRA. It's a totally and separate, distinct party. If I want to take money from the IRA, I have to take a distribution. So take a distribution from the IRA if you need to take out money. Now there's a lot of different ways you can invest in real estate with an IRA. I just want to go through a few common ones so you can see how some people do it. The first is I can just use my self-directed IRA to buy property like a rental, and then the IRA receives the rental income, it pays the expenses, the property sells for a gain, it goes back into my IRA, and I go buy another property or buy another investment. Now, a rental is going to be the most common. That's actually what I do. I have my own self-directed retirement account. It actually owns an LLC. That LLC owns real estate and also owns some notes on real estate. And because I like to invest in what I know, I feel like I have a better competitive advantage. But here we're just showing the basics here. I'm going to get into the LLC in a second here, by the way, of just the IRA owning rental property directly. Now, remember, these have to be investment properties. The retirement account cannot own like the house you want to live in. So don't think of your retirement account buying a house that you're going to live in. Okay, these need to be investments, not personal assets. Now, another common thing people do with a self-directed retirement account is rather than having their retirement account own the property, they'll have their retirement account loan money to some third party who uses that money to buy real estate. And this would be common. Let's say you have money in your self-directed retirement account. Let's say you had money in a TD Ameritrade IRA or an old employer 401k, and you roll it over to an IRA with a custodian who lets you self-direct. And you say, okay, ABC Trust Company that has my IRA now, I want to loan money to John. John's a real estate investor, friend of mine, and he's fixing and flipping a property and needs some money to fund a rehab and buy a property. And I'm going to loan him money at 12% and 2 points. So now your IRA doesn't own property. It's kind of playing the private bank here or a hard money lender, and it's loaning the money. It'll have a promissory note. So John's company's got to pay it back. And you probably get a deed of trust or mortgage secured against the property, because if you're being the bank here, you got to do what the bank does when you want to get a lien on the property. So that's another strategy is I don't own the property directly, but I may just own a note or on a property that someone else has borrowed money from me, and maybe they're flipping it, or they could even be doing a buy and hold themselves. Now, one important part here is you can't use your IRA to loan yourself money or your spouse money. This would have to be a third-party person. It could be a friend or another investor, or maybe a more distant family member like an uncle or cousin or something. But your close family members are prohibited, and I'm going to get into that restriction here in a second. But I'm just keeping this big picture. What can you do? So remember, first thing, your IRA, and this is probably the most common, just owns a rental property directly, gets the cash flow, gets the gain when you sell it for a profit later. Second option, retirement plan can be like the bank. It owns the note on the property, and it's getting points and interest back in the retirement account. Now, another option to think about is maybe you have an IRA, but you don't have enough money to buy a property directly, but you've got enough money to make a down payment to buy a property with the retirement account and get a mortgage to fund the balance. Now, this is possible too. This is a little more tricky, but you could use an IRA to buy real estate. Let's say I had $40,000 in this IRA. I wanted to buy a $100,000 rental property, and I was going to get a mortgage for $60,000. And this can work. So my $40,000 will go down to purchase the property. The IRA owns it. The IRA is on title 100%. I get a mortgage to fund the balance. And now the rental income is going to go to the IRA. The IRA will pay expenses on the property, including the mortgage interest, and make the mortgage payments. And again, when I sell it for profit, the profits go back to the IRA. Now, whenever you get a mortgage, when an IRA or retirement account's buying a property, there's two things you got to know. The first is the loan must be non-recourse. A non-recourse loan means that you as the IRA owner do not guarantee the loan. You're not signing for the loan. They're not using your personal credit. When the bank lends money on that property, the bank is simply saying, If the IRA defaults, we're going to foreclose and take the property back. But we're not going after the IRA, and we're not going after the IRA owner personally. We have no recourse to that, only on the asset we loaned money to. It's called a non-recourse loan. Now, there's a number of banks that have specialty loan products just for IRAs buying real estate that are these non-recourse loans. Those are the banks you want to use. Don't try to go to your regular lender. I know Done For You knows the lenders that are, work in this area, and that's who you want to work with. They'd be like North American Savings Bank, First Western Savings Bank, First Bank. There's a few of them out there that have entire departments now that do these types of loans for retirement accounts buying real estate, because this area has been growing. So that's the first thing you need to know. It's got to be a non-recourse loan. Again, you as the IRA owner cannot guarantee the loan. There's a restriction on that. So nor could your spouse or your kids or parents. So you have to get this non-recourse loan. Now, the second point to this is a tax called UDFI tax. Now, this is something I'm not going to be able to get into in the presentation today, but there's plenty of resources on my website, and I'm going to point you to all the free stuff at the end here that you can go grab off my website that has more content to get all the detail on this. But the second thing you want to know, if you leverage a purchase of real estate with debt, there's a tax called UDFI, Unrelated Debt Financed Income Tax. Essentially what it is it's a tax the IRS applies to the profits you make from the debt in the deal. So if we go back to the example I gave earlier, my IRA puts $40,000 down, it buys a $100,000 property, I get a $60,000 loan. For UDFI tax, the IRS looks at that and says, well, 60% of this deal is debt. And because 60% of this deal is debt, we're going to tax 60% of the profits. The other 40% of the profits go back to the IRA because that represents the retirement plan's investment. You don't pay tax on that money. But the other 60% is debt, so they want to tax that and have the IRA end up paying a tax on that income. So let's say I had a profit of $10,000. I sold the property at a $10,000 gain. They would look at that and say, all right, $4,000 that goes back to the IRA. That's the 40% that represented the IRA's investment. You don't pay tax on that part. The other $6,000 of the gain, though, is subject to a capital gains tax under UDFI, which would be 20%. So on that $6,000, you'd pay 20%, which is $1,200, and the IRA ends up filing its own tax return and paying the tax. Now, again, we won't have time to get into detail on that. In the end, really, if you only have $40,000 in your account, you're buying a $100,000 property, it's still a good thing. If you're making money on that property and having to pay this tax, that means you did a good job on the investment. So don't think of this as punitive or a bad thing, or avoid this. I have a lot of clients actually that are smart about this and say, hey, I have enough money in my IRA. I could buy one property outright with cash, or I could buy 2 or 3 and get a non-recourse loan. And almost every time it's more sense for them to buy 2 or 3 and get a non-recourse loan, so long as they're good properties that are going to have the good cash flow. Because paying the tax along the way is only a part of the profits you're making. So you're getting more money working for you, more dollars at play, more property, and in the long run, you're much better off. So just keep that in mind. If you get a loan to leverage the purchase price, remember it's got to be a non-recourse loan, and remember this UDFI tax that can apply on the profits you make from the debt. Now, when you get a non-recourse loan, there's a couple of things to keep in mind. You've usually got to have 30 to 40% down. The banks that give non-recourse loan on rental properties and IRA buys require you to have 30 to 40% down. And that's because if the IRA defaults, they have to foreclose and take the property back. They can't go after you, or they can't go after the IRA. So they want to make sure there's enough money down. The second thing is it has to be an income producing property. So you can't just buy land or something. They want income off the property that they can see that's going to pay the rent. And then last, here's some of the lenders' websites you can look at here. These are the websites you might want to jot down that where they have their programs for non-recourse loans. All right, now let's get into what you can and can't do when you use an IRA. Now, you'd be surprised. There are very few restrictions on what your retirement plan can and cannot own. This is it. This little list right here, collectibles, life insurance, S corporation stock, that's the only thing your IRA cannot own. So it can own LLC interest, it can own limited partnerships. Obviously, you could own publicly traded stock. That's just what most people do. It could own mutual funds and stuff like that. Again, what most people do. But it can own real estate. It can own an LLC that owns real estate. It can own a note against real estate. It could own tax liens and tax deeds. I mean, all that stuff it can do. And it doesn't matter whether it's a commercial real estate property, a residential rental. It could be a short-term rental. I mean, there's plenty of options out there of what it can be in the real estate context. The only thing it can't be is your personal residence. That's what's called a prohibited transaction. So let's get to that rule. This is a really, really important rule to understand. It's called the prohibited transaction rules. And the prohibited transaction rules is essentially a rule that applies to your retirement account, whether it's an IRA or you do a 401k, whatever you're self-directing, that says your IRA cannot transact with certain disqualified people. See, the prohibited transaction rules don't restrict what your retirement account can buy. It restricts whom your retirement account can transact with. So, for example, there's people that the IRS has said, or I should say Congress, when they created the law here, says are disqualified people. And disqualified people includes like the retirement account owner, their spouse, their kids, their parents. I'm going to go through that list here and put it on the screen. But my retirement account can't transact with those people. And the reason for that is retirement accounts are tax preferred accounts, right? You don't pay tax when you make money on investments with the retirement account. Because of that, Congress, when they created the account, said, well, we don't trust your account to be transacting with you personally or with your spouse or your kids or your parents, because we think you're going to commit tax fraud, frankly, and you're going to manipulate transactions to avoid tax. Now, we'll obviously let your retirement account transact with unrelated people and even more distant family members, but there's this list of people that your retirement account just cannot transact with. And I'm going to go through that list of people here. But here is what happens if you violate the rules. If you violate the rules and you engage in what's called a prohibited transaction, you're going to get one of these from the IRS. Believe me, if you ever get correspondence from the IRS, and you get this, in the box in the mail, it's not a good piece of mail to get. I mean, unless you're the lucky people that get a refund. But like for a lot of investors or people out there, you don't want anything from the IRS. No news is good news. So if you engage in a prohibited transaction, what will happen is you lose your entire retirement account. So if I have $1 million IRA and I commit a $5,000 prohibited transaction, the whole $1 million IRA is distributed. It's no longer considered a retirement account. I get taxed on the distribution if tax would be due. If I'm under 59 and a half, I get a 10% early withdrawal penalty. It's pretty drastic. You basically lose the privilege of having that retirement account. Now, if you have other retirement accounts that are not involved, those are not affected. But the account involved in the prohibited transaction, the whole thing gets distributed. So we want to avoid it and make sure we're conducting transactions properly. So now there's 3 variations of a prohibited transaction. I'm going to explain each here on a separate slide because it's important to understand each one separately. But let's go through these and one by one, and we'll start with the easiest, which is called a per se prohibited transaction. And a per se prohibited transaction occurs when an IRA engages in a transaction with a disqualified person. Now, I'm going to come back to this slide here, though, that's right there. So we have an IRA engage in a transaction with a disqualified person. Now, a transaction includes purchase, sale. Really, anytime money is going in and out of your IRA, that's going to be a transaction. Now, if that transaction occurs with a disqualified person, that causes a per se prohibited transaction. So the important part really is to determine, well, who's a disqualified person? Now, you as the owner of the IRA are a disqualified person. Your spouse is disqualified. Your parents, your kids, companies these people own, you or your spouse or you and your parents own 50% or more of, are disqualified. So for example, let's say that my dad had a piece of real estate he was selling. And let's say I wanted to buy that with my IRA. Okay, if my IRA buys that real estate from my father, that's my IRA purchasing property, which is a transaction from a disqualified person, my father. That would cause a per se prohibited transaction. So I could not do that. But let's change the facts a little bit here. Let's say instead I'm buying property from my sister. Let's say my sister is selling a property and I want to buy it with my IRA. Now it's my IRA purchasing a property transaction, but it's buying it from my sister. Siblings are not disqualified on the list. I don't know why, but brothers and sisters aren't on the list. So neither are aunts or uncles or more distant family members. So it's possible for my IRA to purchase the property from my sister. Now, usually, of course, when you're buying real estate, you're going to be buying from unrelated people. So hopefully you're not running into this. So in that instance, you're buying from some other seller and that you don't even know who it is really until you just met them on the property. So they're not going to be disqualified. But keep in mind, these certain people here listed on the slide here are disqualified. Your IRA cannot transact with them. Your IRA can't pay them fees. It couldn't, if your IRA owned a rental, it couldn't lease it to your kids, for example. That would be prohibited also because they're disqualified. So remember, the IRA needs to hold investments for use by third parties that you're buying from unrelated people, people who are not disqualified. Now here's the list of who is disqualified, and these are the people you cannot engage in a transaction with. You as the owner of the IRA, you're a fiduciary to your IRA, so you're disqualified. So your spouse, your kids, your daughter-in-law, son-in-law, spouses of your kids, your grandparents, and again, these companies you own 50% or more of. All right, now the next type of prohibited transaction is called an extension of credit prohibited transaction. Now, an extension of credit prohibited transaction occurs whenever your IRA extends credit with a disqualified person or a disqualified person extends credit to the IRA. The main restriction here is that you basically for real estate is you cannot guarantee a loan for a property your IRA is buying. So the example I gave earlier about an IRA buying real estate and getting a mortgage, this is the reason, this rule here is the reason you have to get a non-recourse loan, because you cannot guarantee the debt or extend credit for your IRA because you're a disqualified person extending credit, violating this rule. All right, now the last version of a prohibited transaction essentially says that a disqualified person cannot benefit from an IRA's investments. So for example, let's say that I'm a real estate agent. My IRA is going to go buy a property and I want to get the 3% buyer's agent commission on the deal if that's being offered. Well, if I get that commission, I'm a disqualified person financially benefiting from my IRA's investment. That would cause a self-dealing prohibited transaction. Now, I could be the agent on it if I wanted, but I would have to waive the commission. Or I could try and negotiate the commission and get a purchase price reduction of 3%. There's other ways to try and address that if you're an agent. So that would be one example. You can't make personal money or personally benefit financially off the IRA's investment. Another would be is you can't have personal use or benefit of the asset. Let's say you bought a vacation rental property and your IRA owns it and it rents it out 51 weeks of the year. There's 1 week where nobody's staying at it. So you say, well, I'm just going to have my family go stay at it. No one else is there. It's going to be vacant. I'll just go stay at it and we'll have a vacation. Well, you're a disqualified person and you're now benefiting from your retirement accounts investments by being able to stay at it. That would also cause a self-dealing prohibited transaction. So the bottom line is disqualified people, which includes you as the account owner, cannot receive compensation from the IRA and benefit from it financially, personally. Obviously, the IRA can benefit from itself and its own investments by having a great investment. Nor can you stay at or have use of the assets because that would be personally benefiting from the retirement account's assets by being able to stay there for free. All right, now there's something called a checkbook control IRA or an IRA LLC. And this is a strategy used very, very frequently by self-directed IRA investors doing real estate deals because it gives them a lot of flexibility and control. If you remember this slide earlier, I talked about if I have an IRA buying real estate, I'm not on the title to this deal. My IRA custodian is. Let's say ABC Trust Company, FBO Matt Sorensen IRA. That's who's on title. That's who gets the rental income, my custodian. That's who's going to wire the money to purchase it and pay the earnest money, who signs the contract, who signs the closing papers, who has to hire the contractor. And everything's going back and forth with the custodian. I'm telling them, do this, do that. Did you send this money? Did you send that check? Authorize this. It's a lot of back and forth on a real estate deal. So a lot of real estate investors, rather than having their IRA own the real estate directly, is they're going to have their IRA own an LLC. The LLC in turn is going to own the real estate. And what happens in this situation is I have my self-directed IRA. Let's say I had my IRA at TD Ameritrade. I transfer it over and roll it to the new self-directed IRA custodian. And I say, all right, new self-directed IRA custodian, invest my money into this new LLC I set up. It's written properly for IRAs to be owners, and we set these up in my office. And my IRA is going to own it 100%. And I want to invest $200,000 from my IRA into the LLC. Now, the IRA custodian is going to review the LLC documents. And if the LLC documents are done properly, there's a lot of IRA restrictions and rules that have to be in them. They'll authorize the $200,000. And let's say I called the LLC XYZ Investments LLC. They'll cut a check for $200,000 written out to XYZ Investments LLC. Now I'm going to go out and I'm going to be the manager of the LLC when I set this up. My IRA is the member, and member means owner in LLC words. So my IRA owns the LLC 100%, but I'm just simply the manager of the LLC. Manager is the person who has authority to act for the LLC or sign for the LLC. Manager of the LLC is kind of like president of the corporation. That's the person who has authority to act for the LLC. So if this is your IRA, you can be manager here of the LLC. And that way, when they write the check to XYZ Investments LLC, I'll go to my bank, just whatever bank you want to bank with, and you'll open up a regular LLC business checking account, deposit that investment, the $200,000, into the LLC bank account, and then you'll be able to sign checks from the LLC. You'll be able to send a wire to purchase property. If the LLC is going to buy property, you can sign the contract to purchase the property. You can sign the closing papers. You can hire the contractor, and you're just paying all this out of the LLC's bank account. It puts you in control here to be able to purchase and sell investments and really be in control of what happens. Now, the important thing to remember here is you don't own that LLC. Don't ever take money from the LLC. The IRA owns the LLC. So if you ever want to take money, you have to send it from the LLC back to the IRA. It goes back into your IRA with your IRA custodian, and then you take a distribution from the IRA. Now, there's a couple restrictions here on what you can and can't do. The first thing is, if you're the manager of the LLC, you can't take a salary. There's a case where a guy, it's called Ellis versus Commissioner here. He did this structure. He was the manager of the LLC, and he started paying himself a salary for being the manager because he wanted some money personally. That's a prohibited transaction. IRS audited him. He lost in tax court. We've always told clients you can never do that. Our documents will restrict that. And the custodian makes sure the documents restrict this as well as some other things. So you can't receive a salary or any compensation for being manager. Also, if you're buying real estate, you also can't physically work on properties. As manager of the LLC, what you can do is you can perform administrative and investment oversight tasks, which means you can visit the property, see what needs to be done, hire the contractors, hire the professionals, the property managers. You can do all that stuff as manager, but you can't perform physical work on the property. Like you can't put on the tool belt and remodel the kitchen. Now, again, what you can't do, you can't pay yourself a salary. You still can't benefit from the LLC's investments. Don't take money out of the LLC bank account and put it into your personal funds. You got to keep that LLC bank account as sacred retirement plan money. Now, if I sell this property for a profit, the money goes back to the LLC, I can just go buy another one or buy multiple properties. I mean, that LLC can own multiple assets or properties. The key is, if I ever want to take money personally, I don't take it from the LLC. It's got to go back to the IRA, and I take a distribution from the IRA. Now, in this structure here, this would be the most common IRA LLC structure. It's pretty straightforward and easy because there's no tax return required by the IRS. This is called a single member LLC or a disregarded entity. The IRS does not care to have a tax return for the LLC. Everything flows through for tax purposes down to the IRA, which the IRA doesn't pay taxes. So there's no tax reporting you need to do. You just need to keep this LLC active in whatever state it's registered in. And usually you want to set up the LLC in the state where you're buying the rental property. And if it's multiple states, for example, you could set the LLC up in the first state you buy property and then do what's called a foreign registration into the next state if you buy property in a second state with the same LLC. All right, now I'm going to go to option 2 here. If you have questions here as we're going, just make some notes. That's cool. I'll come back. I'm going to try and hit some questions here. Now I can have multiple IRAs on an LLC. This could be my Roth IRA, my traditional IRA. This could be my IRA, my spouse's IRA. This could be my dad's IRA, my IRA. This could be my friend's IRA, my IRA, or this could be multiple. This could be 4 or 5 IRAs. You know, the rules are pretty much the same here. The benefit here is I can pool multiple accounts into one LLC and get multiple sources of funds to then go and buy out a property. Now, it's a little more complicated because I got more people involved and there's some additional restrictions here I'll go over, but it is possible to pool multiple retirement accounts into one LLC that goes out and buys a property. Now, let's say this is my IRA and my wife's IRA. And let's say my IRA puts in $30,000 to the LLC. My wife's IRA puts in $70,000 to the LLC. Well, my IRA is going to get 30% ownership in the LLC. My wife's IRA is going to get 70% ownership in the LLC. The LLC in turn is then going to go out and buy the property, receive the income, and the profits, if we want to send it back out to the members, to our IRAs, are going to go, you know, if we have $10,000 of profit here we want to send back, my IRA owns 30%, so it's going to get $3,000. My wife's owns 70%, it's going to get $7,000. So now let's say the LLC needed more money. We're going to have to put money in based on ownership. If the LLC needed, let's say $1,000 for an expense we didn't plan on, and the LLC didn't have any more money, we'd have to put in $300 for my IRA and $700 for my wife's IRA, again, based on the ownership percentages. So once you set this up and fund it with, like, let's say spouses' retirement accounts or any retirement accounts between people who are disqualified, like your IRA, your dad's IRA, money's always got to go out based on ownership percentages, and new investment coming in's always got to follow that same ownership percentage from when you set it up in the first place. So that's somewhat restrictive if you do combine accounts here. Now, another downside thing to think about here is this LLC is a partnership for tax purposes. So this LLC needs to file a partnership tax return. Now, there's no tax due on a partnership tax return. It's an informational return filed to the IRS that says, here's what the LLC made. Here's how much gets attributed to this IRA that's a member. Here's how much that gets attributed to this IRA that's a member. But you have to file that partnership return each year for the LLC. So it's kind of a headache that you just have to do that. Back on this other structure, there's no tax return you have to file to the IRS. But of course, here you would have the partnership return. But again, the benefit is the ability to combine multiple accounts if you needed to combine multiple accounts to buy a specific property. And that is somewhat common. Okay, now I'm not going to get too far into this, but this is just, there's just more options here. You could have multiple retirement accounts and individuals. This could be my retirement account, my wife's retirement account, our personal money. This could be, you know, my account, my college roommate, you know, retirement account, and my neighbor that wants to put in some personal money, and we all pool it into an LLC to buy a property. Now, again, we always break up the ownership in the LLC based on dollars invested, and then the LLC goes out, buys the property, receives the income, and the LLC can keep the money and just go buy another property, you know, but if we want to send the money back, it's got to send it back to each owner based on their ownership percent. Now, again, partnership tax return here because multiple owners in this. Now, these are more complicated, obviously, because there's more people. Our office charges $1,500 for an IRA LLC like this. These ones back here, it's $800 plus the state filing fees. This one's much more straightforward and easy. And I would say this is the most common that people will use, is this type of structure where their IRA just owns an LLC 100%. Okay, then we got 2 more topics I just want to highlight here. The next is there is a tax called UBIT tax. UBIT tax is essentially a tax that will apply to a retirement account if a retirement account receives business income. See, retirement accounts, when they were created, they're supposed to receive investment income. Now, investment income is rental income, capital gain income, which is what you get when you sell the property for profit, interest income if you're loaning the money out on a note, dividend income, which is what you get if your IRA owns Microsoft stock and Microsoft pays you a dividend on your stock. That's all investment income. And if your IRA gets that, you never need to worry about UBIT. And for most people in real estate, they're going to get rental income as they're owning the property and capital gain income when you sell it. And if that's the case, you don't need to worry about UBIT. But there are some scenarios if you're doing a real estate development with your IRA, you're doing new construction where you don't hold it as a rental, you just immediately flip it and sell it. Or a lot of clients I have that use their self-directed IRA, they flip properties with it. They'll buy a property, rehab it, and flip it with their IRA. You can do that, but if you do a lot of those flips in your IRA, more than 2 or 3 a year, the IRS looks at that IRA as in the business of real estate as opposed to investing. So those are just some problem areas there, those 3 categories on the slide of where you can run into this tax called UBIT. Again, there's some exemptions to this: interest income, rental income if you're buying rental properties, capital gain income when you sell the rental property, or you'll never have to worry about this. But I just wanted to note that because you can run into it in other real estate areas when you use an IRA. All right, now I gave this example earlier. Remember, if you leverage an IRA with debt, there's that tax called UDFI that gets applied to the debt part here. That's the example I gave earlier of the 100,000 property that had 60,000 in debt. This is just the calculation. I gave you that example earlier, but here you'll see it actually on the slide. Sorry, I got ahead of myself there. All right, now the last topic I want to cover, and I'm going to come back here for questions, is you can use what's called a self-directed 401k, also called a solo 401k. Now, this isn't for everyone, but it is for people who are self-employed. Maybe you're a real estate investor or a real estate agent. Maybe you have a small business or a consulting company, and you have no other employees. The only owner of the business, or the only employees in the business, is you and any owners or your family. And if that's the case, you qualify to set up what's called a solo 401k. And a solo 401k can be self-directed, but there's some benefits to it for people who are self-employed because they can put up to $55,000 a year into a solo 401k. They can invest it into real estate. There's no UDFI tax if they leverage those types of accounts with debt. You saw earlier, IRAs can get hit with it. A solo 401k does not require a custodian. When you have an IRA, you have to have a third-party custodian. Like I was giving the example of, ABC Trust Company. You have to have some third-party custodian of your IRA account. With a solo 401k, you can self-trustee it. You'll actually have a bank account directly in the 401k's name, which you can be trustee of the 401k, and you'll have signing authority for the 401k. Now, we set up 401ks. You have to have a pre-approved plan document with the IRS, which we have. This is not something you can individually get approved with the IRS unless you want to spend hundreds of thousands of dollars in legal fees. But we have pre-approved plans that we offer for clients. We set up solo 401ks for around $1,200. But again, if you're self-employed or you have a small business on the side with no other employees, we can adopt a solo 401k. You can put up to $55,000 a year into it. You can also roll over retirement accounts if you have them. Let's say you've got an IRA or 401k, from a prior employer maybe. You can roll that into your 401k. This is, let's say, maybe your S corporation you have, your small business, and that can make contributions into this of up to $55,000. And really the kicker on the solo 401k, or the concept, is because it's a 401k just for you, the business owner, you make the contributions rule as generous as possible. Why not? You're the only employee and you're such a good employee. So I'm just going to make some generous contribution rules here. So I can put a lot of money into it. I can roll over existing accounts, and then that 401k can go out and buy a property. Now, the solo 401k does not work if you are not self-employed. So for some people, they're like, well, I'm not self-employed. Then don't even think of this. This isn't an option unless you later become self-employed. Also, a lot of people, if it's like, well, I have a large IRA already, or I got a couple $100,000 I'm rolling over for a 401k, I got the cash I need to work with, then just do a self-directed IRA. But if you're like, you know what, I'm in my 30s or 40s or your 50s, and I'm like, I want to keep contributing, I want to try and max out more dollars in, and I'm self-employed, solo 401k is a great option. So I just want to throw this 401k option out there. As you get to my website, you'll see I've got a lot of resources on that too. My goal here is try and get you educated to know what your options are, that you can invest in real estate, and know kind of the stumbling blocks here, which is UBIT, prohibited transaction rules, and know these different account options. Now, this is just the 401k rules on how you get all the money in. And again, it's a total of $55,000 that you can get into a solo 401k each year. Now, this slide here at the end here, that's my website, sdirahandbook.com. If you go to that website, the first thing you'll see, or one of the first things, is my free toolkit. And my toolkit has a lot of videos. It has kind of my top videos of what you need to know when you get started in self-directing an IRA. And it has my free ebook in there too, which is Self-Directed IRAs and Real Estate. Now, my main book is the Self-Directed IRA Handbook. It's $20. You can get it on my website or on Amazon. But the main book, I pulled out all the real estate sections and put it into this ebook. So if you're like, I just want to get the primer on real estate right now, go get it for free. It's on my website there. Now, you get signed up for our newsletter, but it's a really good newsletter. We've been doing it for years. My partner and I, Mark Kohler, if you guys know Mark Kohler, we have lots of good articles in there. A lot of our stuff gets published in Entrepreneur. It's been in Yahoo Finance. We've been quoted in lots of other places that carry our articles. And so they're quality stuff. Also, we have our podcast that's on there that you can follow, updates for shows for our podcast, which is called the Refresh Your Wealth Podcast. We've had 750,000 downloads of our podcast. It's a good place. A lot of self-employed people, real estate investors follow our podcast for tips and strategies. So, so that's the website, sdirahandbook.com. All right, now I'm going to come over here and try and see if I can figure out the questions here. Kevin, feel free to chime in if you've got some.
Yeah, sure. I'm looking to see. It looks like one of the questions that we've got was actually from our live room over here, and it says, "What if I invest in a private fund that flips many properties per year through my self-directed IRA, but I'm just receiving passive quarterly distributions? Would this be subject to UBIT?"
Yes, that would still be subject to UBIT. So even though you're not involved in the flips, if it's just like an LLC or a partnership that's passed through, and that what the problem is, what happens is when that company does their tax return, they have to say that the income is business income, so to speak, as I explained it, and that it's, from all these flips. So what they're going to do is they have to put it in box 1 on the K1 that your IRA receives. This is the tax reporting form your IRA would get for its share of profits. And if it's in box 1, that's income. That income is subject to UBIT for an IRA. Now, if you think about it, IRAs can never be actively involved in flipping a property. I mean, I guess you can have your IRA own a flip 100% directly, but IRAs don't do services or work. I mean, you're kind of directing the IRA to do it. So, sorry, you'd still have UBIT in that scenario.
Now, if anybody has any other questions, if you're joining us on the Zoom conference, if you look down at your bottom panel, if you just kind of take your cursor down towards the bottom, you're going to see a Q&A. And that's where if you click on that, you're going to be able to ask us a question, and we're going to be able, I can defer over to Matt and he can answer it. It doesn't look like we have any questions right now, so I'm going to just give it another little second here. Matt, thank you so much. What an incredible batch of information. And just so everybody knows, we're going to have this information here for you. It looks like maybe I have Stephanie that has raised her hand. I'm going to see if Stephanie has a question here. Stephanie, if you want to put something in the chat, you should be able, if you do have a question, I see that your hand's up. If you do have a question, you could put something in the chat and then we'll be able to answer you. But Matt, thank you so much for joining us and for being here. We are going to have this content. We'll be able to repurpose it and put it on the website, and we'll send it out in an email because this is just incredible stuff. Again, that if you're looking at your screen, the website that you want to go visit is sdirahandbook.com. And like Matt mentioned, he said this to me the other day too. He took all of the stuff that isn't real estate, stripped it out, and you can get that for free. They do have an incredible podcast and incredible incredible batch of content that they put out on a really consistent basis. And so, Matt, anything else that you want to share with us before we let you go?
No, that's it. I just wanted to say, I'm glad you guys are talking about this topic. It's kind of one the savvy people in real estate are getting their hands around. And think about your money, and the stock market's at highs right now, but do you really trust it to be there? Maybe you diversify. Again, this is the largest section of investable cash, so it's a place where a lot of people have their money now. I've been buying real estate with it myself just because I trust it and I believe in real estate. As you mentioned at the beginning, the benefits of real estate. I like the cash flow on the rental income, and I like that the thing goes up in value too, and the real estate appreciates. So there's some great benefits to it. And the last thing I'll say is it's cool to see Frank also on here, and I know he's speaking next. So I haven't seen Frank it's been a couple years now, but it's good to see him speaking just right behind me. And we live in the same town, but we have to connect on a Zoom conference like this to say hi.
Right. That's right.
Thank you, Matt. It's been a real pleasure to be able to sit here at my office and enjoy your presentation. I really appreciate that.
Yeah, it's awesome to see you.
Yeah, we're going to have Frank here in just a second. I got a couple questions real quick before we let you go, Matt. I've got one from Stephanie, and she says, I've heard that there's also a type of self-directed 401k that involves creation of a C Corp. Could you speak to the major advantages or disadvantages of using an LLC versus a C Corp?
Yes, that is that structure is used in the franchising world. It's called the ROBS, rollover on business startup. And you would never use that in real estate, never, because you would add a C Corp, which C Corps have to pay corporate tax, and corporate tax got reduced to 21%, but it's still 21%. So if my IRA owned real estate, for example, I'd be paying 21% on the rental income now, 21% on the capital gain. It just doesn't work for real estate. What people use that 401k and C Corp structure for is if they want to buy a franchise with their retirement account, and they want to work in it, it's called ROBS, rollover on business startup. So that's where that concept comes from. It's different really than a self-directed IRA in kind of the real estate world. But it's something to use if you want to start a business and work in it. And again, franchising is the area that probably pushes all that content out. Companies like Guidant and Benetrends are ones that do those.
Awesome. Okay, wonderful. Yeah, thank you for that. A couple more questions. Larry asked, can anyone just move their money from a regular 401k into a self-directed IRA, or are there some companies that prohibit that? And so I know we've run into this in the past where we've had clients that have money and it's captive with their current employer, but they'd like to move it out of the 401k and into a self-directed IRA because of all the unbelievable benefits, like you mentioned, especially for real estate. So will you maybe just speak to that real quick? How would that work?
Yeah, sure. So the biggest roadblock is if someone has, let's say, a 401k or a retirement plan where they currently work and they're not yet retirement plan age being 59 and a half. So if I have a 401k at a former employer or I've got an IRA already, you can always move those accounts. The one where you get handcuffed, though, is if you still work for the company and you have a 401k that's built up there and you're not retirement plan age. If you're in that scenario, the company that has your retirement account can put handcuffs on it and say you cannot move it. And frankly, most of the companies do. So that's probably the area where most people get stuck that want to self-direct that can't, is existing 401k, but they still work at that company and they haven't reached 59 and a half yet where they could roll it out even if they work there. Everyone else, though, can move it. It's a former employer 401k or a 403b, or I've got an IRA at Fidelity or, whatever. This could be a Roth IRA, a traditional IRA, a SEP IRA. All those accounts can be moved over to a self-directed IRA.
Awesome. Great. Yeah, that's perfect. Let's just make sure, Stephanie, do you feel like you had your question answered? You were in the chat, and then we had Larry who asked those questions. Did you guys if you have any other further clarification that you want, feel free to either put it in the chat box or put it in the Q&A. Otherwise, we might be about ready to let you go, Matt. So if there's any other questions, okay, yeah, Stephanie says, yep, thank you. We got that taken care of. So you did good, Matt. It's almost like you know what you're talking about. You know what I mean? It's almost like you've been doing this for a while.
Everything else, don't listen to what I say outside of this context. In this world, I know what I'm talking about. Outside of this, you don't want to know.
And Larry says you answered his question as well. So wonderful. Thank you, Matt. Thank you so much for being here with us and for sharing this unbelievable content. We're so thankful to have you. And everybody, again, go to sdirahandbook.com. I'm just going to, I'll go ahead and put that in the email that will follow this broadcast. We'll make sure that that's included in there. So if you want to go and click that link and get some resources, it's available to you. And otherwise, Matt, thank you so much for joining us. What an incredible batch of content. Really good stuff. Thank you so much for being with us tonight.
All right. Thanks, Kevin. Thanks, everyone.
Okay.